Good afternoon, everyone. I'm Pamela Hastings, and Relationship Manager here at Barometer Capital Management, and we welcome you very warmly to another Barometer Readings webcast on this beautiful July 4th afternoon. Happy Independence Day for all the American viewers out there, and happy belated July 1st, Canada Day, for all of our Canadian viewers. As always, I'm pleased to present David Burrows, our Chief Investment Officer here at Barometer Capital. And on today's call, we will be pleased to provide you with a macro update. And of course, at the tail end of the conversation, be delighted to address your questions. So don't be shy. You can email me at phastings@barometercapital.ca, or you can hit us up via Zoom through the chat or the Q&A. And with that, I turn the conversation over to our one and only David Burrows. Good afternoon, David.
Hi, Pamela. How are you?
Good. Thanks, David. Look forward to this update.
Happy 4th of July, and to all the Canadians, happy Canada Day. It's kind of a quiet week, generally a positive week. We are just one moment. I noticed something here. See if I can. Well, looks like we've got a video picture. Anyway, less to talk about. Good week in the market over the last week. Certainly, the month of June was strong. We saw great evidence of broadening out in the market, and so for those who haven't watched in a while, some of the wobbles in the spring have been slowly righting themselves. The equally weighted S&P has started to perform better, in fact, than the market cap weighted. And when we take a picture of the long-term view of the S&P, we continue to be above this rising 200-week moving average. Though we touched the touch point at the low in October. And despite lots of concerns around recession and potential economic headwinds and all of the geopolitical risks that we all have spent all of our time following, market is watching and looking beyond some of these things, and market has been working its way higher. So we are as high as we have been in 52 weeks. We're into the month of July, which tends to be a positive month of the year. And the economic data has been somewhat favorable. So we talked earlier on about the fact that how the second 2 weeks of June very often was slightly negative. Market did pull back a little bit, and almost on cue, late June, market turned back higher. Here's the S&P. This is the high back in the end of 2021. A bear market that was substantial, going through a bottoming process October, a higher low in December, a higher low in March. And here we are now at 443 on the spider. So, you have to go back a fair ways, April of last year, to have been levels where we are now. Certainly one of the concerns that we had going along the way is that a very high percentage of the return, exceedingly high percentage of the return, coming from the 10 biggest stocks. In fact, year to date, the S&P, as of 2 weeks ago, 85% of the return in the market had come from 10 stocks, which, going back over a long period of time is an extraordinary number. That being said, NASDAQ, has been very, very strong since the market bottomed at the end of December, and has been marking its way since then. The Dow, despite the fact that it has lagged, it's up 3% on the year, 3.7%, but similarly bottomed in October, had a sharp rally from October to December, which probably needed some consolidation, consolidated over a period of months. Lots of people during that period of time looking for safety, moving money into defensive sectors, worried that the economy is going to roll over. And here we are at the beginning of July, and the Dow has been reaccelerating, actually coming out of this consolidation that has been in for many, many months, and making multi-month highs. So it's good to see the market broadening out. We look at the TSX here in Canada, S&P TSX, we made a low in October, a higher low in December. And again, like the Dow, because it's a more economically sensitive index, did certainly consolidate and correct, put in 2 higher lows, and had a sharp move higher over the last 6 days. Canadian dollar has been on a bit of a tear. That also probably helps to have a little bit of money in Canada. And some of the sectors that dominate the Canadian market have certainly acted better. If we take a look at the equally weighted S&P, or the RSP ETF, Similar pattern, a series of higher lows. Again, a sharp move higher through the month of June. That, in fact, was a stronger move than what you got in the market cap weighted or the index weighted most heaviest in the largest companies. Pulled back a little at the end of June and is starting to move higher again here. So we're really seeing across multiple market caps, multiple sectors, strength broaden. And in fact, we're also seeing markets broaden globally. We've had a major breakout in the Japanese market. Japanese market was in a very long-term bear market. It actually dates back to 1991, broke out at the beginning of 2021. And while global markets were sloppy, we've really seen a very sharp acceleration in the Japanese market. Probably doesn't hurt that Warren Buffett has been vocal about the fact that he sees good value here and has been a major buyer of Japanese equities. We've seen a lot of good news on the Indian market, the Indian economy, Modi having a very successful visit to the US, and certainly some attention being paid here. We've seen the Mexican market come out of a range that it's been in since 2017 and moving higher month by month. We've seen some markets in South America move higher. So really, for the first time in many years, going back actually to 2011, global markets are performing very well relative to US market. In fact, in many cases, outperforming. So it opens up a broader range of opportunities. If you take the basic concept that over time in a healthy market, strength should broaden. We've had broadening participation in global markets for equities around the world, which means there's a very strong underlying support for equity ownership and the equity asset class. Equity asset class continues to be in a bull market. When we look at fixed income, we saw the generational low in yields in 2020 after falling from 1981. We had a sharp move higher in the 10-year yields and really across the curve. We broke all of the declining moving averages. And now for about 10 months, the interest rates have been in a fairly narrow band. If we put it under the microscope, we know that there's been a ton of money that's come into the bond market over the course of the year. We know that the bond market has become very crowded. Again, people looking for defensive positioning, much like they did at the worst point in 2009. Probably wasn't the time to be overly defensive then, probably not the time to be overly defensive now, because through those bond purchases, thinking that a weak economy might lead to lower yields. In fact, what's happening is the opposite. 10-year yields after consolidating from November of 2022 through the present have broken above the most recent range and started to move higher again. So there's two things that could be impacting that. One is that the Treasury is issuing a lot of new bonds, refilling the coffers after they came so close to the brink in the debt ceiling standoff. But second, people are starting to recognize that maybe despite rate increases, the economy isn't going into recession. And maybe things are a little bit stronger than what people had expected, which maybe means rates stay higher for longer. And it's been our premise really since rates began to rise in 2020. This is unlike any of the rate increase cycles we've seen since 1981, where rates would rise, choke the economy off, and you'd see rates plummet again. It does not look like that is the case. I think that the economy's strength has confounded a lot of experts. Our view has not been that we are headed to some major calamity, partly because some economically sensitive sectors have been very, very resilient in the face of all this. But I think that there's some positioning that's on the wrong foot. People who got very defensive maybe in the wrong spots. When we look at the TLT, the long bond ETF, made the high in 2020. It's made a series of lower lows. All of the moving averages are moving lower. It's in a downtrend. And recently broke down below this support. And technically now it opens up targets at lower dollar prices, meaning bond prices going down, yields going higher. Same thing for the aggregate bond index, which encompasses multiple maturities and multiple issuers, long-term, short-term, medium-term, corporate issuers, government issuers, same picture after consolidating since September breaking down below that support level and looks again like prices are moving lower. So very careful on bond positioning. Our only bond positioning continues to be very short-term bonds, which we've used in some cases as a proxy for some cash, and frankly, just to get some short-term yields, but probably not the most productive place to be. Stocks relative to bonds, the S&P relative to the 10-year bond ETF has re-accelerated, meaning stocks outperforming bonds, and they have been really since 2020. We continue to think stocks in a secular bull market, bonds into a secular bear market or multi-year bear market, probably not the most fruitful place to be. The last time rates started to rise from a generational low in the late 1940s, bonds gave very low single-digit returns for 15 years. In fact, net of inflation, negative returns. So we would be cautious here about being too careful and focused on just getting a single-digit yield that gets eaten away by taxes and inflation. When we look at commodities, after reversing off the low in 2020, a very sharp move higher into the Fed rate hike cycle aimed at slowing down inflation. In fact, commodities were very, very resilient. We've narrowed in this range and started to move higher. So things like agricultural commodities after consolidating, moving higher, uranium after consolidating, moving higher, natural gas producers after consolidating, moving higher, lithium after consolidating, moving higher. It looks to me like the constraints put on commodity prices through the rate hike cycle is now resolving higher. Our premise has been the very long bear market that these things have all been through and had broken out of, put a floor in place that means likely commodity prices outperform for many years. So when you go through a rate hike cycle, you can do one of two things. You can say, we're going to get very defensive and hope just to ride it out. That's for people who need to be fully invested, need to be somewhere. But that's not where you're going to make money over the economic cycle. Our premise has been that if these things can be resilient and hold up relatively in price, that as we get beyond the Fed rate hike cycle, they're likely to move sharply higher. And we want to be invested for the economic cycle that's coming at us, not the difficult environment that we have been in. So the worst case scenarios of a deep recession or a sharp slowdown or a significant breakdown in inflationary prices has not taken place. And what's happening on the other side is it looks like markets are starting to look beyond the slowdown caused by rate hikes. If we look at commodities relative to bonds, after a long period of underperformance, again, broke out, consolidated, and now starting to move higher on a relative basis. Real estate. From a long-term perspective, it's hard to see how real estate prices move sharply higher while rates are moving higher. Probably the most interest rate sensitive asset you could buy, largely because in many cases you're using leverage to make these purchases, and higher rates makes it harder to pay higher prices. So real estate relative to stocks underperforming continues to be an asset class that we are not that interested in. And finally, currency. US dollar made a peak in the end of 2022, has made lower highs since then. Moving averages are moving lower. We're trading below the 200, the 150-day moving average. We've been unable to make a higher low. Continues to look as though the US dollar can continue to weaken versus world currencies. And that probably benefits things like commodities and global markets. And then finally, I mentioned last week, Bitcoin looks like it's starting to wake up, it continuing to firm up, something just to keep an eye on. This is not something we have a significant stake in. We do have a little bit of Ethereum and Bitcoin in our macro portfolio, but it is up 50% over the course of the year. So the reason that I care so much about US dollar, and I talked about this a couple of weeks ago, is the last time the US dollar started to fall on a secular basis or a multi-year basis was in 2003. And the US dollar fell versus the euro, the yen, and the pound from 2003 through 2008. During that period of time, commodities outperformed stocks and bonds. If you look at the MSCI emerging market ETF, PIE, from 2003 through 2008, it moved sharply higher. If we look at the Goldman Sachs Commodities Index from 2003 through 2008, sharply higher. So these are things that have been out of favor. These are things that we think are set up to perform well. We are seeing the pieces fall in place to support those types of moves. Let's talk a little bit about data. Last week, we highlighted that earnings estimates, despite fears of a slowdown, estimates for 2023 have started to rise, and estimates for 2024 have started to rise. Earnings estimates have continued to improve into the end of the second quarter. We're now into the earnings period. We'll start to see earnings reports in about a week. It'll be interesting to see how the market reacts in general. I think people had taken down their estimates quite a bit over the course of the year, maybe got a little bit too aggressive. Business conditions appear to be a little bit better than what had been expected. And investors are starting to pay a higher multiple for forward earnings. And that probably is helping to see why markets are lifting higher. Earnings growth deceleration is flattening out and maybe turning the other way. The comparisons are going to get easier for earnings year over year, and markets and investors looking beyond. When we look at the PMI data, this is quite interesting. We look at the prices paid as coming down. That's manufacturing prices paid data. The Fed wants to see that. In pink, we see employment costs starting to come down. That's what the Fed wants to see. The PMI data in general has been weakening, but the new orders component have bottomed out and looks like they're starting to improve. So maybe it is that the market isn't so crazy about starting to look beyond and starting to act better, because maybe some of this data is starting to give the Fed what they need to step back from a Fed rate hike cycle. Now, we use our process to make our decisions. We don't have to be everywhere. We think that 70% of return comes from being in the right neighborhood, the right asset classes, understanding the structural backdrop, making sure we're positioned for that. So that means we probably don't have a ton of bonds because we're pretty negative bonds. And it means that we do have equities, that we've broadened out our holdings to international stocks, that we do have some commodity and basic materials exposure and energy exposure, because probably they resolve higher. And then we try to use our bottomed up process to find specific ways to express our view in single securities where we can see relative to their peers, they have fundamental characteristics that are improving, good, getting better. From a top-down perspective, we're always looking for parts of the market that are showing improving breadth, where more and more securities are participating in a rally. If a market is seeing expanding breadth, it's healthy. Buying is spreading. There's no bear markets ever take place while the breadth of an advance is expanding. And on the other side, where we see deterioration, we want to avoid. We want to, if we have positions, tighten up stop losses, stop putting any new positions on. And so long as breadth is deteriorating, be cautious. So where we stand out generally is through an extended decline. We'll get defensive, wind up with some cash, and not nick ourselves to death buying declining securities. The other place that we win is when things start to engage and we start to get into a prolonged uptrend or strength in particular parts of the market. We tend to get focused in those areas and stay invested. We think that there's some pretty clear themes in this market. We do see expanding breadth. Percent of stocks in uptrends in the US now has been expanding over the last many weeks. The short-term indicators, percent of stocks above the 50-day moving average, are getting better. Over 70% of stocks in the US market are trading above their 50-day moving average. Globally, almost 70% of stocks are trading above their 50-day moving average. When we look at the US market further, percent of stocks with positive weekly momentum or upward trajectory is above 70%. And the percent of stocks trading above their 150-day moving average is pushing 60%. Globally, we're seeing strong improvements in those underlying metrics. Canada, to this point, has lagged. So while we are winning with the currency, you have to be very specifically focused and targeted in single names. So let's talk about that leadership. In the end of May, a month ago, the average sector had 35% of stocks in uptrends. You can see many of the sectors on this bell chart with small letters, meaning breadth, was deteriorating. If we look at it today, it looks a little bit different. In the last week, really good strength in some of the more value-oriented sectors like energy up 5%, materials up 4%, industrials up 4%, financials up 3%. Real estate had a bounce, but that's been an outlier relative for real estate over the course of the year. And at the other end of the spectrum, communication services, staples, and healthcare, the defensive sector is really underperforming. When we look at it today, a month later, the average sector has almost 10% more stocks in uptrends than it did at the end of May. You can see almost everything in capital letters, which means we're seeing a broad-based advance. Our job isn't to say what should happen, it's to understand what the market's telling us. The market is telling us it is slowly improving. For those of us that weren't 100% focused in tech, the first part of the year has been frustrating. But with a view that we will get to the next cycle, early cycle sectors should be starting to participate. So tech continues to act well. The relative strength continues to be strong. Hasn't been making relative strength gains since the end of May, but the prices are moving higher with the market. The semiconductor sector, which is the early cycle part of technology, the most economically sensitive, the one that would be very tightly tied to early days AI investments, has seen nice rising relative strength. And we've talked about NVIDIA and we've talked about Broadcom. Today, we'll talk a little bit about Applied Materials, which makes equipment that makes semiconductors. And we know that they're expanding semiconductor production in facilities around the world, and specifically in the US. The industrial sector, one that you would expect to be doing very poorly if we were headed into a recession, really is leading the market. We made a low in July, actually prior to the October low in the market, where we retested that low. In December, we made a much higher low. In March, we made another higher low. In May, we made another higher low. And after consolidating, much like some of the consolidations we looked at earlier today, broke out and is moving sharply higher. Now this is made up of a bunch of different areas. You know, the industrials sector, equally weighted, has been making new relative highs versus the S&P. That's one important point. Aerospace and defense is a sector that has done well within industrials, really, of course, since the beginning of conflict in Ukraine, continues to act well. Mid-cap industrial machinery companies in the US, though, are acting better. We've talked a lot about the theme, which is reshoring of manufacturing capacity to the US. For obvious reasons, companies don't want to get caught in supply chain problems that they got caught in during the pandemic. But there's also a push to become more independent in what might become a multipolar world. Within the mid-cap space, we've talked about large cap defense companies. Howmet Aerospace is one of our larger positions. It's a $20 billion market cap company that makes cast machine parts for aerospace, things like wheels and structural parts, things that have very, very low tolerance for variance and very high specifications. The only company that really competes with Howmet is a company owned by Warren Buffett. These two companies have a very high percent of the market, and it's a very profitable business. Expectations are this year for just over 20% earnings growth, 2024, closer to 25% earnings growth, and the company just continues to chug along. Also in the industrial space, a large position for us across the portfolios is GFL Environmental. You know, this company, started by Patrick DeVici, is focused in liquid and solid wastes. And as industrial companies are busy, this company is busy. And you can see, obviously, it's been a great performer over the course of the year. Beyond these, the transports in the industrial space also moving higher. Transports this past week hit a 52-week high. And again, a highly economically sensitive group. If we were to look at transports versus utilities, you see that transports have been leading all through the year, telegraphing that maybe the economy is a little bit stronger than some of the most cautious people expect. Consumer. Well, the consumer actually continues to be relatively strong. Now, I think that this is mislabeled. This is the equally weighted First Trust Consumer Discretionary ETF. You can see, much like some of the other sectors we've followed, making higher lows all the way along. And in the last month, since the beginning of June, making a sharp move higher of a little over 11%. Now, a bunch of things doing well within consumer discretionary, some retail, some leisure, but the home builders really are about the strongest. This group is now trading above the highs from 2021 prior to the bear market. Highly economically sensitive group, one that should be hurt by higher rates. But the fact is, there's just not enough new homes hitting the market. And people who are in homes with 30-year mortgages don't want to give them up. So market's tight. And we've talked a little bit about Lennar. We've talked a little bit about D.H. Horton. Century Communities is the third company that we have awaiting here. Credit to Jim Skatakis. This is a company that focuses on entry-level homes. Average home price a little over $350,000, which is hard to imagine living here in Toronto. But this company is very, very profitable and should have a big earnings bump in 2024. Let's talk a little bit about materials. Now, I recognize that high rates are there to try and tamp down the cost of goods. And in many cases, we've seen that in some of the consumer products. We've seen some tamp down of inflation and employment. But some basic materials just continue to be very, very resilient. You can see this is the steel ETF SLX. The steel ETF was in a range from 2012 through 2021, 10 years. At the worst points in the 2015-16 slowdown, hit the low end of the range. In the 2020 sell-off, going into COVID, hit the low end of the range. Look at how quickly it recovered to make new highs. And despite the rate cycle, how it's traded back and forth, but basically trading at the high end of the range. So the steel sector is one that I think benefits from some of the changes in global trade and local production in a better position than imports. And companies like Stelco and some of the large US steel companies perform really, really well. This is up 14% over the course of 2022 in what was supposed to be a tough year for materials. Copper miners, after a long bear market, in a narrowing range for consolidation, but inside the group, seeing some names certainly perk up above multi-month highs like Foran Mining, which we've talked about on this call recently, Freeport McMoran, even we're seeing improvement in Teck Resources. Natural gas. Natural gas started coming out of its consolidation range about 4 weeks ago. We've seen now, this is a shorter term picture, but of the oil and gas producers ETF XOP, same picture. And I recognize this is getting to be a bit of a broken record, but there are just a ton of groups that after multi months of an investor back and forth tug of war are resolving higher, XOP resolving higher. And I know that the services ETF XES, which is oil well services, up 8 to 9% over the last 30 days. Financials. Now, this is a group that was certainly under the microscope 3 months ago. We talked about focusing on the largest, most resilient ones because it was likely that we were going to see dividend growth. In the last week, we had the results from this year's stress tests. And coming out of that, multiple large banks have increased their dividends. We think that the yields in a lot of the large banks are attractive, and we think the opportunity is that we will see dividend growth, and that seems to be playing through. So stronger relative performance. On the other hand, the defensive sectors continue to be weak. Now, we've mentioned they act a lot like banks. If you have a low growth rate, but a high dividend payout, it makes it more like a bond proxy. The bond proxies continue to be very weak on a relative basis. If the market thinks that we're going to go beyond the risk of a recession, it is unlikely that new buyers are going to come into these groups because these are the things that likely people let go in order to gain more economic sensitivity. So a lot of money's flown into these groups, but no performance. And when we compare high dividend paying stocks or dividend growth stocks, the RDVY ETF, which outperformed so strongly through 2020 and 21 until we hit bear market, bottomed on a relative basis, dividend growth versus high dividend, and again, reasserting the dominance of a dividend growth theme. If we think we're into a long-term period of rising interest rates and fits and starts, then investors are going to need a rising stream of income, and the dividend growth cohort is the one that is most attractive. This is what we're focusing on in income portfolios. High beta or economically sensitive securities are outperforming relative to low volatility defensive securities. Value is accelerating, and the value themed ETF VOOV is making a 52-week high. So our job is to put our money where our mouth is. We're focused on early cyclicals, technology, financials, industrials. Consumer discretionary has come up in our portfolio. Healthcare's an underweight. Energy is an overweight. It's early cyclical. We've got an overweight in materials and continue to have underweights in communication services, staples, real estate, and utilities. Now, I would feel a lot smarter if all of our money had been in technology for the first half of the year. But my guess is, as markets are looking beyond, financials, industrials, consumer discretionary, and energy and materials are well suited for the upcoming cycle. Our job is to be positioned for what's coming next. Canadian dollar continues to strengthen, so we do have Canadian dollar exposure. Volatility continues to wane, not showing a sign of major near-term concerns. Credit spreads, or the excess returned corporate bond investors' demand to take corporate risk to buy a corporate bond as opposed to a government bond, are coming down. So the bond market is not telling us that there is a problem on our doorstep. And as I mentioned, we're into a stronger seasonal part of the year, the month of July. So we're going to continue to watch all of those breadth indicators for signs that things are faltering. But at this point, they're not. We're 19 months into the bear market that started December 2021. That is long by terms of cyclical bear markets. The pullback was about as bad as you would expect for a cyclical bear market, but things are getting better. And what we're there for is what comes after cyclical bear markets, the significant run that can go for 2 to 4 years. So we'll watch for signs of weakness. If we get them, we'll get defensive. We may sound like a bit of a broken record, but until things change, the positioning that we have, I think, is the right place to be. So thanks so much for your patience. And Pamela, if there's any questions on this 4th of July holiday, certainly happy to answer them. And we'll go from there.
Thanks so much, David. We do have one question that just slid in. Given the strength in technology with the enthusiasm in AI, could we see a substantial rally as we saw in the .com era?
Look, I think that we are seeing a very substantial rally, and I think that we're participating as best we can. I mean, we're I think 23% technology by weight, which is a pretty substantial weight. But I will say that the one thing I am concerned about is that tech multiples can be compressed by higher rates. So it has tended to be over the last many years that as rates moved down, tech stocks moved up. As rates moved higher, tech stocks ran into a headwind. There is a lot of enthusiasm for AI. My guess is, like in the late 1990s, things maybe get a little bit ahead of themselves. So I want to watch that. And during a period of falling US dollar and rising rates, it tends to be that you would be more benefited in things like industrials and materials and so on. There is real sign that there's a technical setup to support that. At this time, we want to be participating in both. We think that tech definitely has momentum and tech definitely has a big following, and there's some wonderful companies. But the other groups that we've talked about have really great valuations, are really under-owned, and have shown a sign that they've got, big technical bases to work out of. So look, our job is to try and find the various pockets of leadership and participate in them as long as they work. And, we'll continue to update those on a weekly basis.
Thanks so much, David. Well, that concludes the questions we've received this afternoon. And as always, I will leave you with the final word.
Yeah, look, this sometimes is not an easy job. Our team is working really, really hard. We spend a lot of time communicating with one another and looking at new ideas. As things change, we'll continue to raise them. If you got questions about your portfolios or an existing client, and I would like to have a conversation, please reach out. We're on. Everyone's working hard. If you are not a client and you'd like to ask some questions, again, reach out either by email or by voice. You probably know how to find us. And in the absence of that, we look forward to seeing you again here next week and see what the market brings us through the early part of July.
Thanks, David.
Thanks, Pamela. Thanks, everyone.